Matt Orton. He's Head of Advisory Solutions and Market Strategy, joining us on the show this morning. Matt, great to have you as always on India Market Open. And on an important week, all eyes on Fed, 25 basis points largely expected. What really is going to be the reaction if it's all pretty much priced in?
It's a great question. I think there's still a little bit of uncertainty with respect to what the Fed's actually going to do. So the market pricing is looking for, I think, majority leaning towards a 25 basis point cut, but it's much closer than it has been over the past couple of weeks. And on top of that, I think what the market's really going to react to is going to be the guidance that we get from the economic projections, and what the Fed signals is going to kind of be the depth and the pace of the rate cutting cycle that we get, because the market is pricing 10 25 basis point rate cuts between September and the end of 2025. I think that's a little bit extreme. I don't think that we're heading for a recession, as we've talked about in the past. I think the economy is slowing. It's not breaking or cracking. And so I think the market might have to pull back some of its rate cut expectations, which I actually think would be a great opportunity for investors to use any sort of volatility or downside a little bit more opportunistically, because there's still a lot of good value in this market, and building balance, I think, should be a key theme for investors going forward.
Matt, given a choice between EM equities, US treasuries, and US equities, with an assumption or a hypothesis that the Fed will cut 25 basis points and sound of future price cuts or rate cuts until December, what would you choose?
I think you have to have U.S. exposure. The United States earnings growth are still very, very strong. And I think there's a lot of pockets of the U.S. market that still look very, very attractive, especially tangential artificial intelligence plays like utilities, electrical equipment companies, data center buildouts. But our emerging markets look attractive. Investors are very underexposed to emerging markets across their portfolios. It's been a significant underweight for a while. And on top of that, there's a lot of markets in the EM complex that will benefit from a US dollar that continues to weaken. So I think if you can strip China out of the emerging market equation, which I've been advising to clients, is to get EM exposure ex-China, I think there's going to be a longer-term uphill market for a lot of these emerging markets. Look at Indonesia, look at the Philippines. India is the prime example. India has been my largest overweight in the emerging markets complex for the past 2 years, and it remains my biggest overweight going forward just because of the growth and a lot of attractive corporate profiles across the spectrum of the market. So I think you've got to have both.
Hi, it's also Samina joining in. Just a quick perspective check. So global equity markets have done okay in the last 2 months. The MSCI World Index is flat. MSCI Emerging Market Index is down 4.3% in the run-up to the Fed. Commodity prices have been in a doldrum. HRC steel trades closer to $700, which is almost a record low. Even metals like copper, which is in high demand due to the focus on renewable energies, is down 8% in the last 3 months. Crude is sub $70 a barrel. So while I know there's euphoria, there's excitement, talk about risk on trade, the fact that commodities are reeling under pressure is a clear indication that global growth is slowing down. Isn't that a real worry for you when you buy into risk assets?
You know, Simina, that's a really good point that you bring up. And when I talk with a lot of clients, they do bring up the fact that you're having weak commodities, particularly relative to gold, that continues to strengthen. And I think you almost have to bifurcate the conversation. And this really leans into the idea of why selectivity is so important going forward. Simply owning the index, owning the emerging market index, still gives you about 30% weighting to China. And as you started at the beginning of the show, China has been the weak part of the emerging market complex, but you're seeing breakouts across a number of other markets, and you've got the Nifty at record highs. So there's a lot of differences between markets, and I think that's what's so exciting for me as an asset allocator, as an investor, is that you can pick and choose your places in the market. Just like in the US, you might not want to be overweight the Magnificent Seven over the past month, but there's been a big run in utilities. There's been a big recovery in some of the data center plays. Real estate, which is a little bit more rate sensitive, has continued to increase. So the main message that I can give to investors is, rather than just owning the entire index, pick and choose the specific sectors, pick and choose the specific markets that you want to get exposure to and where you're seeing that growth. And I think that is what's going to be critical for success over the coming months and really over the longer term.
All right. Thank you, Matt. Pleasure as always to speak with you. And of course, it's going to be a week focused a lot on global flows and global action.